You have to have a setup that you cannot frame that will be opposing your weekly expectation. Said another way is, if you're bearish on the market that you're trying to trade and the dollar index is bullish, that in itself is the first ingredient, if you will, of a symmetrical market. That must be there. They must be diametrically opposed. If you can't see the marketplace through that lens initially, you are not in the first stage of high probability. That's just the way it is. I don't care who wrote books and made courses or whatnot. That's just the way it is. That in itself is not the entirety of your model. That's not how all of your trading should be based on. It just means that that's the first stage. Now, if it's not like that, if it's not diametrically opposed, does that mean you can't take any trades? No. It just means that you're probably best suited doing scalps intraday. And if it doesn't fit your appetite for trading, you simply have to sit on your hands and wait for the marketplace to present the opportunities where the dollar index is likely to move one direction, opposed to what you would expect in analysis in your euro dollar, pound dollar, whatever currency that has the dollar in its name as the secondary. If we have the expectation that the currencies or the currency that you're trying to trade is bearish, you do not want to be able to look at that and see something that would be bullish. If you can frame the idea that, yeah, I could see a buy signal, I could take a buy on that because of this, not impulsively, not because your elbow hurt the last time the euro dollar went up, so therefore now it's hurting today, you're going to try to buy it. That's nonsense. There has to be some kind of argument that can be framed logically as to why the market should go higher or lower. If you can be outlined through the mechanisms that you use for trading, if you can see both sides of the expression in terms of buying or selling short in the instrument that you like to track, you're not in high probability. So there's two ingredients right there for high probability trading. If you're an index trader and you think that obviously that we are in a risk off scenario, that means dollars higher, we have to anticipate the likelihood that rallies in indices are suspect. That means that they're not technically sound. They're going up there for a reason. What are they going up there for? To reprice to an inefficiency, or it's going up there to run buy stops. They're the only two reasons why markets go up. That's it. That's all there is, folks. There's nothing else going on. There's no animal patterns behind it. Wyckoff is not there. Supply and demand is not there. It's going up there to engage new sentiment, drag them in by their hair, or disrupt the present sentiment in the marketplace. And it's all based on liquidity, either creating the liquidity or removing it and unseating those individuals that are in the market and then taking their position over so that way the market can then reprice for them, not you. It's rigged. And you can be mad about that. You can be scared about that and think, nobody can ever beat this. Nobody ever can, be consistent with it. And that's rubbish because you see my students all over the world now doing it. It's transferable knowledge. And the things that I'm teaching, people are seeing it and they can see it repeat over and over again. And as long as there's a marketplace, as long as trading is accessible to us, it will not ever stop working. So don't worry about it. If we can't trade and then they cut the markets away from us and say, no, you can't trade this. So you don't want setups that you can frame on both sides of the marketplace. So if you're bearish, it should be next to impossible for you to see any reason for it to go higher. No justification for it to go higher. No justification for it to pause. And when you trade in those conditions, that is a low resistance liquidity run. That means the market will move like a hot knife through butter. Just smooth. buttery. That is exactly what you want in your trades. You don't want to be in a trade that when you get in it, it's just spending a lot of time just hanging around your entry. If you look at the executions I share, they're like dynamic. Like when that execution's done, it spends very little time around where I entered and rarely ever moves towards my stop. Now, you've seen me. I've been stopped out and I went back in, did what I wanted to do, and re-engaged it. I executed that. It was live accounts, real money, and people tend to believe that those things don't exist here on this channel or on my Twitter. Like I'm trading with real money, folks. I've talked. So if you can't see reasons for it to go against your weekly bias, if you wanted to see lower prices, or if you're bullish, okay, you want to see it go higher. You don't want to see anything that would be argumentative or reasons for you to doubt the setup. And because you're most of the time it's a brand new trader or undisciplined, you don't have the ability to sit still and demand that the market creates and presents those opportunities where it's so one-sided. It's so one-sided that you cannot not see it doing what you expect it to do. Versus as a brand new student or someone that just maybe watches my video for the first time and you think, oh, I got this. This is a fair value gap. I'm just going to go out there and find the very first fair value gap that I see on the chart. And just, you have to be prepared mentally for it. And your setups need to be in a way where you cannot argue it. If you can see both sides of the equation, being long or going long at the time when you want to be short, that's a trade you should not take. And be comfortable not taking it.